Welcome to IPPFA TV. This is an outreach program of the Illinois Public Pension Fund Association. In today's episode, we're honored to have and welcome Aoifinn Devitt. Aoifinn is a senior investment advisor at Moneta, where I have to read this out so I don't screw it up, where she's responsible for leading the team's overall investment efforts and serving as a liaison to Moneta's in-house investment department. She also operates as the team's Chicago market leader with an emphasis on serving the family office practice. Most important to our viewers, her resume includes the role of the former chief investment officer of the Chicago Police Pension Fund, a $4 billion public pension fund providing benefits, and the benefit promises to 26,000 active and retired members. Additionally, she was the head of investment for Ireland at Hermes Fund Managers, Ireland Limited, along with stints at Goldman Sachs and Cambridge Associates. On top of her professional achievements, Aoifinn hosts and produces 50 Face podcast, which I was on. Awesome. I recommend people to watch it, which highlights diversity and inclusion within the investment industries and other professions. She has completed 55 marathons. Impressive. Speaks German, French, and Spanish, and enjoys traveling, particularly when it involves some skiing in the winter months. Aoifinn, welcome to IPPFA TV. So
thank you so much.
You have broad experience in institutional investing. What are your views today on the opportunities over the next decade for pension funds and similar large long-term investors?
I'd say the opportunities remain very good in the sense that I do think return environment is positive. I do think that the shift into alternatives is ensuring that that return stream is bolstered. And many public pension plans have for some time been building experience in alternatives. So this is not a new area for them. And therefore, they're not, basically beginners at this. They are experienced in private credit, private equity, real estate infrastructure. And as the shape of the equity market changes and more companies remain private, I think that it will be essential to gain exposure to all possible return streams. So I think with the innovation that's occurring within financial services, there is innovation that is allowing greater value to be extracted by the investor. So despite the fact that we've had some pretty toppy equity markets to date and some strong performance, albeit quite a volatile market this year, I do think that the next 5-10 years have a lot of opportunity as the growth story continues.
I noticed one thing when I was in England, that the United Kingdom pension funds were not as heavy in private equity like America is, and it seems to be a new frontier for them. Are you going to see a lot more opportunity now in the UK towards private equity and private equity investing by pension funds?
It's interesting. There's really kind of two fields in the UK institutional investing market. There are the DB plans that would be, say, from the old corporate DB structures. Most of them are coming close to being closed. So they are generally in de-risking mode. Some of them are basically just pursuing a buyout. So they are not generally seeking more risk on their balance sheets. So I'd say no for them. When it comes to the open schemes, and the LGPS, the local government pension scheme, will be the most dominant one of those, they will have room definitely for growth assets and certainly for alternatives. And many are already doing that. But just at the moment, there is some reorganization going on there. There is a lot of restructuring and pooling. And that, I think, will be a preoccupation for the next, say, up to 3 years. And that is likely to probably slow some of the advance into alternatives there among those public plans. Some would have had, say, quite high allocations, similar to the endowment level allocation, about 25 or 30% in alternatives, particularly private credit and infrastructure, whereas others were just dipping their toe in the water. And that's the toe dipping in the water phase that may last a little longer than we would otherwise expect because of this other preoccupation.
Well, regardless of a public or private plan sponsor, how are institutional investors reacting to both the pro-ESG and anti-ESG schools of thoughts? Is that a reaction that's proper, or is it, what do you think is going on with that?
Very interesting question. I think all institutional investors essentially have their own DNA. So that DNA will dictate how they react to the ESG winds, whatever way they're blowing. And that will often depend on their stakeholders and the requests and demands that those stakeholders are making. Many, for example, in the UK, we talked about public plans there, and indeed all pension plans and institutional investors Many of them will have a responsible investment policy, which is well put together and will be evolving. It's a living and breathing document. And they will be generally expecting ESG risks to be integrated across the entire portfolio, public and private. They may have net zero targets of their own. They may be engaged with an engagement partner, which is likely to be most of them will have signed up to the UK Stewardship Code. So most will have an engagement partner that is increasingly looking to be effective with their engagement. So this will probably represent 20-30% of the investment time of one of these institutional investors will be focused on their responsible investment policy. So I'd say they are not generally at the moment affected by the anti-ESG lobby. Within the US, again, it's a factor of the DNA of that institution and how well their stakeholders are demanding or requesting this. I'd say that some are definitely going to be affected by the political backdrop. And in some states, we look at Texas, Florida, for example, they will be, for the most part, being quite keen to divest from companies that are seen to go against the policy of the state. And so in a way, that is jumping on the anti-ESG bandwagon. Whereas others, such as in California and New York, are very much still focused on their responsible investment policy, their objectives, be that around diversity and emerging managers, climate change mitigation, or focusing perhaps on driving good governance, flexing their muscle to drive good governance. So it's really different strokes for different folks, quite literally, in terms of how their stakeholders dictate that they behave.
Well, Ethan, I'm going to turn this over to our Dan Ryan. Dan Ryan is our projects coordinator, and Dan's got a couple of questions he'd like to ask you, specifically more based on what's going on here with the Midwest. And everything.
Well, how is your time differed at a large public pension fund, large to us specifically, $4 billion Chicago police, in the investing environment versus your other experience institutionally, both domestic and abroad?
It's a great question. There's nothing quite like being in a public fund, that's for sure, and in Chicago in particular, bearing in mind that this is governed by the Illinois Pension Code, and we did have objectives around investing in emerging managers. There's obviously an extreme focus on fees, on cash flow, given the funding backdrop. And I'd say that that was really kind of an extreme example of what it is to be in a structurally negative cash flow environment. I'd say many public schemes around the world, in fact, and the UK is no exception to this, are seeing themselves shift from positive cash flow into negative cash flow. And that means they need to think about orienting their portfolio around cash, about taking cash out of their portfolio, whether through dividends or through income, such as through real estate, infrastructure, or private credit. So all of that we did essentially now, probably about 9 years ago at the Chicago Police Pension Plan, because we knew that that was essential to bridge the gap. So that was different. I'd say in terms of the resourcing too, the resourcing was quite different. It is not a deep pocket organization in terms of resources. You have to be quite nimble as a CIO. I had a great consultant partner, but there was no investment office essentially. So I leaned on that consultant partner, but I was quite hands-on myself, going through RFPs, meeting with managers, having an open door approach. And that was how I stayed connected and visible. And that was important to me. Many organizations of a similar size, such as 4 billion, would have a large investment office. It could be 4 to 6 people. They may well have layers of analysts, associates, decision makers, strategy consultants, etc. So I'd say being that lean forces you to focus on what really matters, cutting to the chase and doing RFPs quickly, getting them done essentially. And in a way, we have to really outsource some of the process. So that was certainly different.
Well, you rolled into my second question about funding levels, but you took it a little bit further relative to cash flow. Even a mature public fund, a well-funded mature public fund is eventually going to need cash out of its portfolio. Taxes, contributions from the membership, doesn't take too long for them to exceed pension payments, administrative costs, et cetera. So how would you structure a portfolio? And I'm not asking for free advice, but we do have a large, outside of Chicago now, we're consolidated, a large fire fund, a large police fund. Fire's 8 billion, police are 10. I think they're going to approach 20. I think overall that in total community right now is cash flow neutral. they're getting taxes and contributions from the membership slightly in excess of cash needs. That'll flip. That'll flip in a couple of years, even in a well-funded environment. How do you structure a portfolio around that? Do you have to stay away from the private equity, private credit, alts group, or can you delve in there to some extent? Can those produce cash like the public markets can?
That's a great question, and I never consider it free advice. I consider it simply an extension of my public service. So happy to advise anyway. But as far as, first of all, I think there are a few misconceptions, and that is that when a fund is poorly funded or has a low level of funding, and Chicago plans are often around the 20s, that means that they are essentially on the clock is ticking, and that they can't invest in illiquid investments because they may well run out of money. And first of all, I don't see that as a reality because it is a living, breathing plan. Yes, it has low funding levels, but that's if every single debt became due or every single liability became due in its present value on that day. And that's very unlikely to happen. So therefore, it's not really going to be called on that low funding level. However, there needs to be a focus on the one hand on ensuring that that funding level doesn't get any lower. So the investments need to work for you. So you cannot sacrifice growth. There has to be a focus on growth, which means there cannot be a complete abandonment of growth in favor of income, because income often does forgo that growth return. So ideally, you want to target something that is income generating, but equally is still going to be leveraged to growth, because you still need to make that return so that you can essentially grow the fund and not just tread water or wash its face. So I'd say it does not mean you cannot do private equity, but maybe look at private equity slightly differently. Locking money up in a J-curve fashion for 10, 20 years and not seeing any cash flow return, that may not make sense. But increasingly, there's some very innovative private equity vehicles, such as evergreen vehicles that blend secondaries, co-investments, and will basically mitigate that J-curve. So you will start seeing cash flow return earlier. And that is definitely one way to address the cash flow shortfall that can come with private equity. Private credit, we can start generating cash first quarter in, and then also the infrastructure and real estate investments can start generating cash the first quarter in. All of these are decent inflation hedges as well. They should keep pace with inflation. But I would say that we have to be mindful that the return stream in infrastructure and in real estate and other real assets such as farmland and timber has been a bit unimpressive recently. So we're talking kind of single digits. And getting back to that growth requirement, we cannot sacrifice return when you have that kind of a shortfall. You need to be making your investment assets sort of sweat and do the work for you. So I'd say, again, looking at those higher returning cash flowing assets, such as private credit. And finally, thinking about traditional assets too, in terms of cash flow. Often it's considered taboo to take dividends out of a portfolio of equities. It's considered better to roll them in as total return. We saw that taking dividends on a quarterly basis was one way to essentially have a nice clip of a coupon for cash, but also rebalance and take profit on equities in a very seamless way. So we did that, and we also clipped coupons on the bonds that we held. And that was, again, another nice way of trimming back those bond holdings and having a kind of a quarterly income stream. And finally, when it comes to just, cash is king. And right now, money market funds are not generating a bad rate of return. So just having some cash on hand is not bad. But equally, if you do have dead wood in a portfolio, such as some private equity assets that are really just not doing much for you, or maybe the rump or tag end of a portfolio, think about selling that. And this may not be the best time to sell it, given there's some high profile, large investors that are looking to sell. But we did do a successful sale of a tag end private equity portfolio while I was at Chicago Police that generated about 100 million straight cash for us, which plugged a gap that year. So many different ways. And I think that the formula has increasingly become accepted now but 9 years ago, it was not.
Just a follow-up question: are there market makers in the secondary markets for some of these vehicles?
Absolutely.
Secondary markets. Okay.
At every stage, at every level. We were not selling a large portfolio. We hear a lot about, say, the Yales and endowments today that are looking to sell billion-dollar portfolios. We were selling something around the 100 million range. And we may not work with a large broker to achieve a sale like that, but there are absolutely brokers willing to work up and down the spectrum and even enough that you could do a beauty parade and choose one that works for you.
Very good.
No, so as a CIO of let's say the Chicago Police Pension Fund, did you feel extra pressure because the fund was only funded in the 20% range to outperform? I mean, is the pressures on a CIO of a pension fund that's low, has a low funded level, more pressure for you to outperform than it would be if you were in a better funded position?
Yes and no. I'd say there is a little bit of pressure to outperform, certainly, and not to lose money. Preservation of that precious capital is really of the utmost importance when you know how precious it is and how hard won those contributions are. So certainly that affects the risk tolerance you can have. And it was equally being a public fund, you are always mindful of reputation risks. So we would not invest in anything which could be seen to maybe could look bad on the headlines of a newspaper. We didn't have digital assets crossing our transom then, and we were not tempted by them. But that would be an example today of an area that might be in the gray area of what you might not want to invest in. I'd say so the focus is on not losing money, certainly not having any high profile blowups. That affects the kind of concentration you could have. There's a strong focus on fees. Every penny counts in that circumstance. And I'd say at the end of the day, you want to invest to achieve at least a market rate of return and ideally more. So that pressure is on. But I honestly think that every institution feels that pressure, whether or not they're fully funded or not. I think they always want to at least keep pace with their peers.
I have another question, and it's a little outside that. I'm going to go back to your history, your bio, and I was fascinated that you're also an attorney, and you went to law school, and you went to Trinity, and then you were at Oxford University, and that's a lot of work to become an attorney. I mean, what made you stay focused on the investment side and not go to the legal side? I mean, what was what turned it for you that you really liked being involved in this type of industry?
It's interesting. I worked as an attorney for 4 years, and a lot of my work was on the private equity documentation side.
Yeah.
So working as a documenting other LPs' investments. So I worked with a lot of GPs, but across the table. And I think what it was that I actually really enjoyed being a corporate attorney, but it was maybe maybe it's a personality flaw or a strength, I don't know, that I always want to see, well, what if I like something else more? What might enjoy? And I was very much fascinated by the numbers side, by the deals, by the valuation, by the idea of being a steering strategy. So that really overcame my love of the law, and I just thought I could find something elsewhere. I'd say that being a counselor, though, that has never left me. The sense of holding clients' hand through thick and thin, and now in the private wealth world, that's something that I think is coming to the fore more. And even when you think about the Chicago Police Pension Plan, it was a little impaired given the funding level and given the challenge. Had been an 18-month period of no full-time CIO when I joined. And those kind of strains, that is in effect like some of the clients I worked with as a lawyer that were experiencing strain because they were perhaps in an economy that was struggling or a business that was struggling or were not getting financing. So my career has been characterized by working with clients under some form of strain or pressure. And I think that kind of being a counselor has really been a common thread throughout.
So you feel that the legal aspect actually helped you with being a better investor. You had that had that pool of knowledge, so that actually assisted you with what you were doing.
A little bit, yes, definitely in terms of attention to detail. Most of all, though, it's about judgment, personality, because I worked on so many deals as a lawyer with so many people across different geographies. I worked in New York and Hong Kong. That I think that it just gave me an appreciation for human nature. And investing is a people game, as you know, as we all know. It's about trusting people, assessing their character, and seeing who you trust with your money. So in a way, building that trust is like a muscle and that judgment. And I think I cultivated that there.
Well, that's awesome. I mean, that's really a excellent situation. I want to follow up with one final question, really, and it's the two T's and the big T's in the room. That's tariffs and trade. And are we seeing in your mind, and I've watched you on TV on some of these shows and everything, and tariffs affect trade, obviously. Are we seeing a realignment in the global market, in the global world place, or is this just a correction?
It's interesting. I do think we are seeing the realignment that you mentioned at the beginning. It has not been helped by the kind of on again, off again nature of these tariffs. And I think in effect, markets are very fast learners. We know that they instantly internalize a pattern, or pattern recognition, I think, is just built into markets and participants. So they've seen the pattern now, which is a big swing, a tariff imposition, followed by a renegement of that a few days later, perhaps tariff negotiations being announced, a protracted period of negotiation, and maybe some wins, some losses, etc. But ultimately, sort of returning to the position we started at. So that seems to be the pattern. And markets are reacting now, almost expecting that pattern to persist. So that's on the one hand, you might say it's not really much different. But I do think that the fact that these tariffs have kind of been the genie that's got let out of the bottle, I do think that trading partners now have started to see and imagine what the world could look like should we have a break in that pattern of on again, off again. If it's not off again, I think there needs to be a backup plan and a plan B. And I think the market participants are very quickly scurrying to put in place a plan B, whether that's an alternate supply chain, an alternate trading partner, less reliance on the US, less reliance on the US dollar and US treasuries. So all of that is entrained slowly. It's not a big bang change. So that's happening. That is the realignment you spoke about. And I think we will see that slow chipping away. I don't think US exceptionalism is going to end in one night, overnight, or all at once. I think it will be slowly eroded over time, so much that we hardly notice at times, but it will be eroded. And that's why we're seeing this kind of strong emergence of non-US markets as resilient in their own right. So I think it's a little bit of both in that the pattern doesn't look that different right now, but I do think that the realignment is happening.
Yeah, I agree with you. I think there is a big realignment happening out there, and I myself don't know how it's all going to end up, or what if it's just going to be these little zones of trade or whatever. But we'll see how this all plays out. Anything else you would like to say before we close out with IPPFA TV?
Well, first of all, keep up the good work. I think being a voice as you are for best practice sharing and for basically ventilating some of the issues that are affecting public funds is critical. Public funds often don't get the attention they deserve. It tends to be the large endowments. I think there is a lot of focus on sometimes the negative, the funding picture, and not as much focus on the individuals behind the scenes doing the steady work. I think it is important that we see some of the heroes, perhaps the unsung heroes that are working on imaginative partnerships with managers and ultimately delivering great returns for their beneficiaries in perpetuity. So I think it's great to shine a light on the good work being done by public funds, and thank you for that. And very happy to be a part of your project and the idea knowledge sharing that you bring about.
Thank you so much. And we really appreciate your time today. Again, this is James McNamee, president of Illinois Public Pension Fund Association. And this is a segment of IPPFA TV. And we're very happy to have had Aoifinn Devitt, former CIO of Chicago Police Pension Fund and senior investment advisor of Moneta, here with us today and giving us her thoughts on things. This is a good, outstanding information. So we really appreciate it. And thank you so much.
Thank you.